In this video, we'll talk about substantial economic effect and how a partnership allocation can be respected with respect to substantial economic effect. Partnership taxation is found in Subchapter K of the Income Tax chapter of the Internal Revenue Code. Subchapter K was written and put into the code in 1954. The main theme was flexibility, allowing partners to be flexible with respect to the partnership agreement. Now, allocations. We're talking about allocations here in this video. An allocation is different from a distribution. An allocation is how the income, gain, loss deduction items are allocated to the owners, and that's where we get the one level of tax, and they flow through to the owners. We also call that distributive share. Distribution is when assets or items get distributed to the owners, and that's separate from allocation, so keep that in mind. Section 704 is where we find the rules for the partner's distributive share, again, what we call the allocation rules. So 704A is where we start. And in 704A, it specifically says in the code that distributive share, again, allocations, so distributive share is determined in accordance to the partnership agreement. So we follow the partnership agreement. And again, that keeps with the overarching idea of flexibility. Section 704B continues with that idea and says that an allocation will be respected if it's in the partnership agreement. So it has to be in the partnership agreement. And the second item is that it has what's called substantial economic effect. And we're going to go in depth with respect to substantial economic effect. So it has to have both of those items. And what you see on the screen here, you have a lot of empty space. But what we're going to do is we're actually going to go through the rules of substantial economic effect, and we're going to see how they all play together, the puzzle, the order. Because whether you're taking an exam, dealing with partnership taxation, or you're looking at this issue in practice, you go through the ordering. Now, the idea, again, is that an allocation will be respected if it meets two things. It's in the partnership agreement, and it has substantial economic effect. Now, the allocation might still be respected. We'll learn about later, but we're saying this is kind of like a safe harbor. Like we know it will be respected if it meets these items, these two items. So let's first take the item in a partnership agreement. So if it's not in the partnership agreement, then it does not meet, then the allocation will not be respected under the safe harbor rules, meaning that it might still be respected under other rules, but it won't be respected under the safe harbor rules, meaning it just won't automatically by default be respected. So when it's no, so when there's no partnership agreement, we go to what's called the partner's interest in the partnership. We go to that rule. This is referred to a lot in the tax law, also known as PIP. And I'm going to refer to PIP throughout the rest of the presentation. And that citation, because it's very important in partnership taxation to cite the regs and go as far down as you can. That citation, you're going to find that in Reg 1.704-1B3, and then it's two little i's. It's a bunch of factors that we use. And the factors that we look at, and these are some examples. There's other ones as well. Relative contributions, interest in economic profits and losses, interest in cash flow, and other non-liquidating distributions. So those are just some examples. There's many other examples that we look at, and you can look at the regs there. Now we're going to go into substantial economic effect. Okay, so let's say we do have our allocation. It's written out in the agreement. It's not silent. So now we have to ask, does the allocation, will it be respected? Does it meet substantial economic effect? So we're continuing on. We're saying yes for the rest of the presentation. We're going to assume that it is in the partnership agreement, and now we're wondering if it meets substantial economic effect. Before we go any further, just keep in mind what's going on here. You've got some type of allocation in the partnership agreement. Okay? Let's say we have two partners, and maybe they contributed capital 50-50. But maybe one partner is doing maybe more work than the other partner in terms of managing the business or actually at the business site, and the other partner may just put in money. So maybe the one partner that's putting in more money wants to allocate more income, or there's more losses allocated to that person, whatever it is. The idea here is if you're dealing with this in a partnership tax class or in practice, it's usually what we call a special allocation, or it's some different allocation that's different from just what they contribute, their capital contributions. Okay, so you might have a 50-50 partnership capital contributions, but then it might be 30-70 losses, and then it might be 60-40 gains. So some type of breakup like that. Or you could have a special allocation, like in the Orish case, where everything is 50-50. Everything, income, losses, gains, everything's allocated 50-50. Capital, all that's 50-50. But maybe one type of item like depreciation is allocated specifically to one owner. That's what happened in the Orish case, and that also happened a lot in the 70s, the 80s with tax shelters. And that's actually where these substantial economic effect rules came into place. Now, before we go in again and further, I just want to make clear what you're going to see is substantial economic effect is all about the tax numbers matching the book. So if the tax numbers match the book numbers, then substantial economic effect is going to be fine, with one caveat to that we'll talk about later. So the idea is that if you have $1 of tax deduction or $1 of tax loss, for book purposes, if the business was to liquidate, then that owner that had $1 of tax loss allocated to him or her needs to also bear the burden of that dollar of loss if the business liquidated and distributing out cash economically. So that's the idea. $1 of tax loss equates to $1 of economic loss. So when you're analyzing allocations, it's very important that you focus on the book capital accounts. So you need to show in your analysis, show the book capital accounts, okay? Because again, you're looking at that dollar of economic loss. And also, it's important to show the change in book value of any assets. Because if you have various assets, especially if you have special allocations, you need to show the change in book value of any assets. So go through. If you have a real property that's being depreciated, then you need to show every year, okay, depreciation goes down, and show what the book value is, because a lot of this deals with hypothetical liquidations for book value and various. So you're showing your professor, or if you're doing this in practice, you're keeping track of that. So what would happen is, okay, economically, this is how things would break up. So book value, book capital accounts, and the change in book value of assets, very important. So keep those two things in mind. Okay, now that I've gave you that overview, let's actually get into the details of substantial economic effect. And this is where things get really detailed and really important. If you're in my partnership tax class, when I give a problem on an exam, I expect you to go through the order and show your citations, your sources for all of these items. Okay? To show these items, it's very important, the order. The order, the path is extremely important. For other professors, the same thing, I guarantee it's correct. And in practice, it also helps because it shows you how things flow together. Okay? So substantial economic effect. Again, we have our allocation. Let's say our crazy allocation, right? One partner is allocated 30-70 gains, other part, and then it's 60-40 losses, or special allocation depreciation. Now we're going to dive into, do we have substantial economic effect? So if we have that partnership agreement, which we do, and substantial economic effect, guess what? The allocation will be respected under a safe harbor. So there's substantial economic effect is really broken down in the regs. The regs for 704. There's really three parts to substantial economic effect and three parts to the regs. The first is the normal SEE, or substantial economic effect rules. So I'm just going to write that out. The normal SEE, substantial economic effect rules. And we find those in Reg 1.704-1. Okay? The second one deals with non-recourse deductions. And I'm going to have a video later on non-recourse deductions, but the idea is that with non-recourse deductions, which are deductions related to non-recourse liabilities, the idea is that with non-recourse deductions, well, if you're taking depreciation and it's a non-recourse liability that is used to secure the property, guess what? No partner, the partnership or no partner bears the risk of the actual liability. So the idea is that the lender is one that bears the risk, but we can't allocate the depreciation deductions to the lender. So the idea there is we have to have some special rules, because it's not going to have economic effect. Because the idea is, again, if you're taking $1 of depreciation loss and then you liquidate the business, are you saying economically you have $1 of loss? No, because non-recourse liability, the lender is the one that bears the risk with respect to the asset, because it's non-recourse, it's not a recourse liability, so therefore economically it doesn't match. So we have to have special rules for non-recourse deductions. The third rule is the pre-contribution gain or loss. We call this section 704C. So again, pre-contribution. So I'm just going to say pre-contribution gain or loss regs, and these are found in Reg 1.704-3. And the idea here is if you're trying to allocate gain or loss or depreciation deductions on assets that were contributed to the partnership by a partner where there was a difference between the book value and the tax basis at the time of contribution, we have special rules for that as well. We can't use the normal rules. So this video, we're going to focus on the normal SEE rules. We're going to focus specifically on those rules. All right? So let's continue, and now this is where we get into the substantial economic effect and Reg 1.704-1, these specific rules. All right, so substantial economic effect is broken into two parts, substantiality and economic effect. Now, it looks like we're going to be starting with substantiality. However, because economic effect is more mechanical, we actually start there. So under substantiality, okay, you'll see that this is a path, like a flow chart or pieces of a puzzle. So again, we're starting with Reg 1.704-1. We've got our partnership agreement, right? Now the question is, do we have substantial economic effect? We're applying now for the rest of this presentation. It's a normal allocation issue. It's not a non-recourse deduction or pre-contribution loss. Those two topics are for other videos. So now we're saying, okay, to meet substantial economic effect, we have to meet substantiality and economic effect. To meet substantiality, we first need to meet economic effect. We go in that order. And again, that's because economic effect is considered more mechanical. Now keep in mind, I mentioned this earlier, and I'm going to be reviewing with you a lot to keep this in your head, that substantial economic effect, if you meet it, it's a safe harbor. So the allocation will be respected. But if you don't meet it, you're going to see partners' interest of the partnership, PIP, can also potentially get you there. It's just a factors test. And the IRS can construe it pretty much any way they want, and they argue through factors. So that's kind of, you don't want that. We don't want to be in that PIP land, okay? We want to avoid that because we want to make sure that our allocation will be respected. Think about malpractice issues if an attorney or a CPA, whatever it is. So first we meet economic effect. So now we go to economic effect. All right, so economic effect is broken into lots of parts, or lots of tests that could potentially be met. So that's why this lends itself, again, to this diagram. So the first thing we consider is the basic test. The basic test for economic effect. And the basic test is found in Reg 1.704-1B2, two little i's, and then little b. Sorry, Reg 1.704-1B2, two little i's, little b. Okay, that's where that is found. And again, these sources are very important for my exam or for other professors' exams to cite the regs and where everything's at, because the regs in 704 are very long. If you don't believe me, go check it out right now. All right, there's three parts to the basic test. The first is we have to maintain capital accounts in accordance with Reg 1.704-1B2 little iv. Okay, Reg 1.704-1B2 little iv. All right, the second requirement is that we, on liquidation, so if the partnership was to liquidate, we're going to follow positive capital accounts in terms of allocating out the cash to the owners. So I call that positive capital account liquidation. So on liquidation, the partners get the positive capital accounts. The third is the unlimited deficit restoration, meaning that any partner, if they go negative in their capital account, they're required to restore. Even if it's negative 100 or negative $1 billion in their capital account, they have to restore. Now, if you're looking at these, following capital accounting, Reg 1.704-1B2 little iv, that's basically just following GAAP. I mean, in the regs, it talks about those rules, but it really is following GAAP, following financial accounting, capital accounting, following book accounting. Because remember, when analyzing allocations, it's all about the books, right? Tax must match books. So that's why that's so important. The second, the positive capital account on liquidation, that's also not that bad. So those two requirements, not that bad to do. And these should be in the partnership agreement. The third item, the unlimited deficit restoration, that one you run into trouble. And the idea there is if you are a limited partnership, by its nature, a limited partner is not required to go beyond its investment. So that means that a limited partner doesn't need to go or can't go negative. If they go negative, they don't have to contribute anything to the partnership. That's the idea, unless they specifically say so. But the basic test, one thing I want to stress is that the basic test is an all or nothing test. It's all or nothing. Either you meet it in 1 year or all years, okay? Or I'm sorry, you meet it 1 year and you have to meet it all years. You can't just meet it 1 year and then you fail it the next year. You have to meet it all the time based on what the partnership agreement says. So if we meet all three of those, all right, if we have all three of those, which the idea there is you have to be a general partnership to have that criteria. If you're a limited partnership, it's not going to happen, okay? Because a limited partner cannot meet number 3. It's not possible by the agreement. And even if that's not specific in the agreement, just by nature of state law, a limited partner. So any type of limited liability is going to stop you from the basic test. It's not going to be possible. If you're a general partnership, that's the only way you can have the basic test. So some of you might be wondering, well, then how would we ever have substantial economic effect? Because there's so many limited partnerships, limited LLCs out there, limited liability partnerships, limited partnerships where people have limited liability. And that's a great question. And we're going to talk about that in a moment. That's where we get into the alternate tests. Okay, so if we meet the first 2 requirements, but fail the unlimited deficit restoration because, again, of that issue, then we're going to proceed to the alternate test. The alternate test. And before I continue, I want to talk about what happens if we fail either number 1 or number 2. If we fail number 1 or number 2, right, regardless of number 3. If we fail number 1, number 2. All right, so I have these 2 options. If you have checks in either of the other boxes, doesn't matter because you failed number 1 or number 2. Then where we go next is in the regs, there's a special rule. It's called the economic effect equivalence test. So the economic effect equivalence test. And basically this test, it only applies to general partnerships. So it only can apply if you have a general partnership, nothing else. And this is found in Reg 1.704-1B2, right? Pretty much everything is in 1B2. 2 little i's, and then it's going to be an I. Okay? This is the economic effect equivalence test. And it's a special rule, again, that only applies to general partnerships. And the idea is that if it's similar, if it has an equivalent result to the basic test, but just because you failed number 1 or number 2, well, we're still going to allow you to be able to respect the allocation. So again, this is only meant for general partnerships. So if you're a limited partnership, you might as well just, nope, not going to work. So you have to be a general partnership. And if you have to go through basically the idea, the analysis, the argument that, okay, this would have the same result or the effect doing book accounting, again, showing the capital accounts and the change in book value and how things would be allocated to someone that had the basic test. If it doesn't, so if you fail these 2 elements, right, number 1 or number 2 in the basic test, and you fail the economic equivalence test, then you're going to go here, right? It's no, it does not meet the economic effect equivalence test, right? A mouthful. Then it's going to be partner's interest in the partnership, right? I have A. So anytime we have partner's interest in the partnership, I'm going to use a box, a little square of A. And you'll see that's elsewhere on here as well. Okay, so PIP A. And again, that's a factors test. And that's where we do not want to be because that there's no certainty there. The IRS can come and construe and they can put on one factor versus another. Factors mean there's no one factor that controls, so it's like you're up in the air. It's a crapshoot, and it's going to be tough, okay? It's going to be a tough decision. You want certainty. You want to make sure your life is easier. And again, we want to keep with that overarching goal of flexibility, but at the same time, we want to make sure that our allocation is respected and we have certainty with our allocation. Okay, if we can write out these agreements, making sure that, okay, our parties want to make sure their allocation is respected. Okay, but if yes, then what's going to happen is we're going to go over to substantiality. I'll talk about substantiality later. So that's where this arrow is right here. You'll see this arrow going from yes. That arrow is going to continue over substantiality. But before we do that, let's go back to the basic test. So if we meet number 1 and 2, but fail number 3, then what we need to do is consider the alternate test. And this is also considering economic effect. So this is another test. So basic test we consider first. If we don't meet the basic test, then we go either the economic effect equivalence test or the alternate test. If we're not a general partnership, well, and because we failed number 1 or number 2, then guess what? We need to go on to the PIP. Okay, but if we meet number 1, number 2, and fail number 3, then the idea here is you go over to the alternate test. Now think about it. If you meet number 1 and number 2 and you fail number 3, that means that you are not a general partnership. Because if you're a general partnership, well, under state law, that means every partner is unlimited. So you would meet number 3. So that's why it's not possible for us to merge over to the economic effect equivalence test. You'll see that. So this is basically saying, hey, if you're not a general partnership, but you meet number 1 and number 2, you continue the alternate test. So the alternate test is found in Reg 1.704-1B2, 2 little i's. Sorry for the delay. I just want to make sure I get it correct for you. D. That's a D there. Okay? And this test this can change each year. This is more of a partial test. So the basic test is all or nothing. This one you can change each year. So some years you might have it for a partner, other years you might not. And then you have to do partner's interest in the partnership. Okay? So keep that in mind. This is not an all or nothing test. This could be, oh yeah, year 1 and 2, the allocation's respected, but in year 3, it's not respected. And the reason why is because you're going to see, based on the requirements, they've now failed. So again, you meet the first 2 requirements of the basic test, and there's 2 additional requirements that have to be met. The first requirement is there has to be a qualified income offset in the partnership agreement. And the idea behind a qualified income offset is if you have special events that occur, then basically what happens is you're going to need to make sure that that partner that's being allocated a special allocation is going to have to recoup either gains or reallocate certain ways for unexpected things to make sure they don't go negative beyond their balance, which they can go. And I have a problem, an example that goes through this so you can see how a QIO actually works. But keep that in mind. So the qualified income offset is in the agreement, has to be in the partnership agreement, and then it's triggered through certain events. You can see how that's triggered through my examples, which I have in other videos. The second requirement is the partner that has this special allocation cannot go beyond 0, because we're talking about usually a limited partner that's being allocated depreciation or some type of loss or more loss than the other partner. So cannot go beyond 0 under state law, or deficit committed. So if they commit, okay, I'll go negative 100. You can go negative 100, but you can't go beyond that. Okay? So whatever they commit, the deficit they commit to the partnership, hey, in the partnership agreement, I'm willing to give up to $100 if my partnership balance goes negative 100. That's basically what I'm saying. Now, with those 2 requirements, if we meet both of those, then we go over to substantiality. Okay, and we'll talk about substantiality in a minute. If we fail either of those requirements, then where we go after that is we go on to a special rule. We potentially go on to a special rule. We have to look at substantiality first. So before I come back to this special rule where we fail, I want to talk about substantiality. So substantiality, right? If we have the economic effect equivalence test, if that's met, yes, right? We had a yes here. Or we have the alternate test, okay? Or we have the basic test. We meet the requirements for the basic test or alternate test. Then we come over to substantiality, and this is found in Reg 1.704-1B 2, 3 little i's. Now, substantiality is much more subjective. That's why we consider that one last. But really what it deals with is, independent of tax, does it make sense from an economic standpoint what you're doing? Or are you doing this solely for a tax reason? So the idea here, these rules, these were put in place. Substantial economic effect regulations were really put in place in the 80s because of tax shelters. People were doing crazy allocations, allocating depreciation deductions because ordinary income rates were so high, and then doctors, lawyers, accountants with high ordinary income, they would invest in a tax shelter and allocate depreciation deductions and whatnot all to them so they would lower their other income. And one way to get at that was Congress put in these rules, among other things, passive activity rules, at-risk rules. But the idea here is, okay, we have economic effect. So again, the tax matches the book. So for book purposes, if the business actually liquidates, guess what? That doctor, that lawyer, that accountant that's being allocated this dollar of depreciation loss, they're not going to be able to collect that when the business economically when the business liquidates. The other idea is this done solely just for tax? Because that's what tax shelters were done. You were investing in them just for tax purposes. So we look at two different kind of examples. So again, it's subjective, but there's really two examples that we focus on. We call them shifting, and the other one is transitory. Is it a shifting or transitory allocation? So a shifting allocation means you basically are moving. You're basically like shifting the income to a partner in a lower tax rate, and then your losses, you're shifting them to a partner in a higher tax rate. So you might have like one partner that's in a 0% tax bracket, maybe they're a tax exempt org, and you might have a partner that's in a 30% bracket. Well, you give all the losses to the 30% partner and all the income to the 0% partner. That's an example of shifting. Now, if it's done for a business purpose, you can overcome that presumption or hurdle. But we're just saying that, hey, if it's only done for tax and it's a shifting, it's going to be a problem. It's not going to meet it. Transitory is kind of a little bit more challenging to understand. It's when you have expiring things like NOLs, where, okay, for 3 years, it's what it deals with is time. For 3 years, one partner gets the losses. For the next 3 years, the other partner gets the losses. And it's because, okay, one partner had like some NOLs that were going to expire, so they wanted to take advantage of those NOLs, so they didn't expire. That's the best example to use. There's other ways, again, to look at this. You could look at tax-exempt interest. Oh, we're going to allocate taxable interest to one owner, tax-exempt to another. I have a problem on that. That focuses on that issue with different rates. So if it's shifting or transitory, then it fails substantiality, and then it's going to be PIP. And I have, again, an A there because it goes back to our Reg 1.704-1B3, two little i's, our factors test, which is A. Okay? Partner's interest in the partnership. We focus on factors. Again, we don't want that because the certainty is bad. But if we don't have a shifting or transitory allocation, then it does have substantiality, and then the allocation will be respected. And that's when we're happy because, again, we're talking about certainty. So allocation will be respected. Put a little smiley face there. Now, let's go back because we haven't finished this. Let's go back to the alternate test, and if we fail one or two in the alternate test, then we have to also consider the same idea. Is it shifting or transitory allocation? If it is, then again, we're going to apply the partner's interest in the partnership factors test, which again, we do not want because of the certainty issue. Okay? But if it's not shifting or transitory for the same exact analysis we just did, then we have a special rule. If you have the alternate test, you go there, but you fail one or two of the alternate tests. So meaning you meet the first two requirements of the basic test, but you fail one or two of the alternate tests. Then we have a certain rule. It's called the certain determinations rule. I just call it certain determinations. And what it is, it's kind of like the partner's interest in the partnership, but it's an actual, it's not a factors, it's an actual finite rule. So it's found in Reg 1.704-1B3, three little i's. Sorry. Reg 1.704-1B3, three little i's. And what this rule basically does, we do an analysis. Well, we're going to compare what a partner gets from two respective periods economically if the entity liquidated for book value, so liquidated for book value, and we're going to compare the end of the current year. So we look at the book values and the capital accounts and see what they would get and who bears what versus the end of the prior year. So if you're saying, okay, can they take this allocation this respective year? You say, okay, well, what would happen at the end of this current year if the business liquidated for book value? Okay, obviously, hypothetically, and who would get what? And you follow the partnership agreement, okay? And you allocate based on that way. So you allocate and you say, okay, well, which partner, like if there's a deficit, who would have to make up that deficit? Because if it's a limited partner, the idea is that they're not going to have to go beyond their negative balance. The other partner would. So it's possible that under this test, an allocation might still be respected, even if you fail the basic or alternate test and you get down to certain determinations, and it's, again, provides certainty, more certainty than, or unlike the partner's interest of partnership. Certain determinations is also like the one year it might be respected and another year might not, because again, you just do it, you focus on each year, just like the alternate test. Okay, so we've really gone through everything now. The last thing I want to do is kind of just summarize and just highlight all these ideas. So first thing, again, remember subchapter K, the overarching theme is flexibility. We want to be able to allocate whatever the partners agree to economically. We want to follow the economics. That's why tax equals book. Tax must follow book. And that's what substantial economic effect is all about. So section 704, we find that high-arching theme. 704B says allocations will be respected if it's in the partnership agreement and it has substantial economic effect. So then we said, okay, if it's on the partnership agreement, we follow the partner's interest of the partnership, which is that PIP, right? Factors test. We don't want that because the certainty is not there. If we do have it in the partnership agreement, it's specified, then we have to ask, does it meet substantial economic effect? So again, we differentiated the normal SCE rules, non-recourse deductions, and pre-contribution gain or loss. Non-recourse deductions and pre-contribution gain or loss, those are for other videos, other topics. So we go to normal SCE rules. So for the rest of the presentation, we assume it's just a normal allocation. So when we do this, when we analyze the allocation, we're going to focus on the book capital accounts and the change in book value. You want to show that each year if you're doing an exam problem, showing how it changes. Doing columns and rows with the capital accounts. Doing the book value, showing columns and rows of the book value change. Subtracting away depreciation. Usually teachers love to teach or love to test on depreciation and how that changes. Obviously for practice, you'd want to keep track of those items as well. So to have substantial economic effect under the normal SCE rules in Reg 1.704-1, we have to have substantiality and economic effect. We first start with economic effect. If we go through the basic tests, if we meet all three basic tests, we go on to substantiality. If we meet the first two but fail the third, we go to the alternate test. If we meet either if we fail either the first or second, we go to economic effect equivalence test. If we are a general partnership where it would pretty much be the same, the equivalence of the basic test, then we go on to the substantiality. If we don't, it's partner's interest of the partnership. Okay, we go back to the basic test. If we met requirements 1 and 2 but fail number 3 because it's a limited partnership, some owner has limited liability. Under state law, that's just what happens, right? Then we go to the alternate test. Remember, the basic test is all or nothing. You either meet it or you don't. It's not 1 year and then the next year it changes. The alternate test, though, is different. It can change from each year. There's 2 requirements. You have to have a qualified income offset in the agreement for every partner, and you cannot go beyond 0 or deficit you commit. So if it's a general partner, and I mean, they can go negative there, so that's fine. But a limited partner, they can't. So they can either go to 0 for the allocation, that's where it can change each year, or they can go negative whatever they commit. So if we meet both of those, then we have to ask, is it shifting or transitory allocation, which is a substantiality question. If it is a shifting or transitory, I'm sorry, my apologies. If we fail, I said that wrong. If we fail the alternate test because of requirement 1 or 2 has failed, then we ask, is it shifting or transitory? If it's not, then it's a certain determinations where we check the book value end of this year versus end of last year and what would happen economically based on the partnership agreement. Who bears the burdens, the benefits and the burdens? But if it is shifting or transitory, then we have to do partner's interest of the partnership, which is that factors test. We do not like that. Okay, so then from the basic test, the economic effect equivalence test, and the alternate test, if you do meet those tests, either of those 3 tests, you come over to the shifting or transitory allocation of substantiality. If it's a shifting or transitory allocation, well, unfortunately, you don't meet substantial economic effect, and it's going to be partner's interest of the partnership. So that brings that rule up. But if it's not shifting or transitory allocation, then the allocation will be respected, and you can go ahead and you can rely on that. The last thing I want to stress is, again, the partner's interest of the partnership is a factors test. Now, we don't have certainty, but it might still end up being the way that we want to allocate. It's just a problem because if you think about our legal system, our tax system, we're drafting contracts, we're drafting these partnership agreements. Partners, owners, members, and LLCs, they want certainty. They want to know their agreement will be respected. So keep that in mind. That's very important. So you still have to note that, and if you're writing a problem out or doing this, that the partner's interest of the partnership can still be respected. But if you're doing this as a practitioner, you want certainty. You want to make sure that that actually happens. All right, I hope you've enjoyed this video. And I know it's a long one, but this helps you put in place how all this works together. All right, how all this works together. All right, I have some problems on substantial economic effect. Please look at those. It'll help you even more. And use this flow chart, this path to help navigate that problem.